I'm just going to go over some minor points. Nayia did a very good job of explaining, but down arrow or spacebar.
Down. Well, whatever you prefer.
I don't know. Last time I did this, it was
Yeah.
okay. In the U.S., the 5 most important issues. Keep that in mind. All the terms are negotiable. Okay. Everybody wants to know, well, what are the standard terms? Well, there are standard terms, but even the standard terms are negotiable. Okay. So when you're doing these things, when you're coming up with your term sheet, when you're coming up with your convertible notes, when you're, as Christina explained, you say 5, they say 10, you come up with 8. Everything. So all the terms are negotiable. Keep that in mind. In the United States, this becomes a very important thing. Registered versus unregistered securities. The gold standard, the best you can have are registered securities. Okay? But this requires that you file documents with the Securities and Exchange Commission. And you go through what is called an IPO, an initial public offering. Well, that whole initial public offering is the process to get the securities registered so that they can be sold on the open market. Okay? So you get to sell to anybody. You get to go to the New York Stock Exchange or the over-the-counter, any number of places, if they'll accept it. And then there's any number of avenues. There's no limit on sales. So you can sell to your next door neighbor, you can sell to the, at the peripheral, down the block, doesn't matter, okay? Unregistered securities, okay? There's no filings with the SEC. However, there are no sales on the open market. You cannot walk down the street and sell. So there are limits on the sale, okay? And I will get to in a few minutes the various securities. Keep in mind that a convertible note is considered by the SEC to be a security, even though it's not common stock, it's not preferred. You know, Christina was saying it's a note, kinda. But the SEC will consider that a note, or consider that a security, because it is not, because there is the potential for risk, other than, just the, now does this mean you have to go registered? Does it mean you have to go? No, there are exceptions to the registration. There are things that if you follow, the convertible note will not cause any problems. But keep in mind that not to be too loose. Okay. Securities. Most of the time you're going to be talking about 2 types of securities, common or preferred. Nayia went over a little bit about this, but I'm going to expand on it. Common stock gives the right to vote. It's an automatic. Yeah, these are the people who own it, and they get dividends. So that's basically what common stock is. Preferred is in some areas considered to be better. It gets first rights on dividends. So if the company posts dividends, if you want to distribute money to the shareholders, you must first distribute money to the preferred stockholders. Okay? Then we get into, there are other, which is in the event of liquidation, okay, bankruptcy or closing down the company, they get paid first, okay? But it's like stock. They don't get paid before other creditors. So if ABC Company, if I lent ABC Company $100, and Christina has $100 of preferred stock, and Nayia has $100 of common stock, and there's $150 of cash in the ABC company, I get paid first. I get my $100 plus whatever interest. Christina, being the preferred stockholder, gets the $50 because that's all that's left. And unfortunately, Nayia doesn't get anything. So, because I lent money, I'm a creditor. I stand in front of the preferred stockholder. Okay? I will return back to this and talk a little bit more about liquidation preferences, but right now I want to get to valuation. Okay? Everybody wants to know what's their company worth. Okay? So what and you know, you're trying to figure out how much of the company you're supposed to sell, how much, you know, preferential treatment you're supposed to get. What are the first 5 things? What are the 5 most important things? Everything is negotiable. Okay? It's negotiated. For startups and small companies, you really don't have assets or revenue, so there's no really objective criteria to use to come up with your valuation. If you have a small company and you have revenue, then you can come up with a valuation. But if somebody says, hey, look, I want to invest $100,000 in your business, 100,000 euro, okay? And I want 10% of your company, people say, oh, now the company's worth $1 million or $1 million euro. Not really. That's what its negotiated value is. That's because that's what somebody feels, I'm willing to put in so much money, put in so much risk, and I eventually want to have 10% of the company. So that kind of valuation is a negotiated valuation. You can't really tell anybody that the company's really worth $1 million. It's just you've been able to sell 10% of the company for 100,000. So that's a negotiated. There is no objective criteria to say that really it's worth that. Okay, we've already gone through this. Okay. One of the things that I also want to go over before I get back to liquidation preferences is Nayia spoke about non-competes and non-solicitation. A word of warning, in the United States, the structure, there's multiple states, and in some areas, non-compete and non-solicitation are not enforceable. So that might work to your benefit, it may not. So Nayia says, talk to a lawyer if necessary. I say, it is necessary to talk to a lawyer to make sure that you don't happen to be in one of those locations where the non-compete is not enforceable if that is what you want. Okay? All right. Liquidation preferences. I want to get back up to liquidation preferences. In terms of a convertible note, okay, because a convertible note sits in between stock and a note, because it can convert into stock. And Christina and Nayia talked about, on what terms? Is it automatic? And like I got to my 5 most important points, it's all negotiable. You want to be clear as to whether you want that person that's lending money to your company, as to whether you want it to be automatic. Do you want that trigger to happen? Because you may want that to happen because then your creditors then everybody's sort of in a better position. because otherwise, if it remains a note, if I keep it as a note, and I get to choose whether it converts or not, so let's say instead of me just lending to ABC, it's a convertible note, and I have the right to choose whether I convert or not. So if there's $150 in the company's bank account, and I've invested $100, Christina has invested $100, she has the preferred shares, Nayia, unfortunately, is still common stock, $100, okay? If I convert into shares, preferred shares, then I am in the same boat as Christina. And that $150 gets split between me and Christina. So I don't get my $100, I only get 75. And if I convert into common, then what ends up happening is Christina gets her $100, and then Nayia and I split $50.
Is it, if you don't convert,
Yes.
are you one of the creditors?
You're one of the creditors. That's the thing. It's like, you gotta keep in mind, it's a note until it converts. And then whether you want, and it's negotiable as to whether you're gonna have it automatic, whether you're gonna give the investor the right to convert, because maybe you want the investor to convert into common shares, so that way, at the $100, my $100, that converts into common shares with Nayia, and let's say Nayia is the one that formed the company. Okay? Nayia would like that because at least then she gets some money out of it. She gets to split the $50 with me. I, as the convertible note investor, maybe I don't want that. Okay? And I get back to my first 5 points. It's all negotiable. And I think that's. Is there any questions? Those are my quick points to add to Nayia and Christina. Yes?
Just some statistics to know, what's usual, what's common. For a 100K company, and normal 100K startup, how far-fetched is this this point? Are those points? Whether we have to have it, whether we have to have registered or unregistered.
Oh no, okay, no. You none of you guys want to deal with the hassles of a registered stock. Okay. I'm just explaining what the type, because it's important to know that that these are unregistered securities. That this is what's going to be converted into are unregistered securities, and you have to pay attention to the fact that they're unregistered. None of you want to go through the headache or spend the money to register any of your securities.
They're exempt from registration. Registered is an initial public offering. That's registered.
Well, no, not literally, but that's you can register your securities without going through an IPO.
Right.
Okay, but
That's the normal process.
the normal process is because that's how you you take a company public. Everybody gets to sell their shares on the open market. After a little while, they all become instant millionaires. But it's with registering your securities that you then have a bunch of actual reporting requirements. It isn't automatic unregistered. You have to make sure that you qualify for the exemption, which is why I say
Hire an attorney.
it is necessary to hire an attorney, because you can accidentally, and I have had an experience where somebody accidentally didn't qualify under the exemption. They thought that they didn't have to worry about it, and exposed themselves to a great deal of liability. Fortunately, everything worked out, and they were able to make peace with the investor.
Andrew, can you talk a bit about the terms of that exemption?
There's a variety of exemptions. One exemption is if you're raising less than $5 million. Okay, that allows you to. Well, there's an exemption where if you're raising less than $5 million from unaccredited investors, and so you have something called an accredited investor, and you have this questionnaire. Yeah, they have to fall under these certain guidelines, and the way that companies ensure that their investor, the person who's contributing money, qualifies is they ask these questions. And so the investor has to say yes or no, and if they say yes to enough of the questions, then the company doesn't have to worry about it. The stock is not registered, the security is not registered, and they don't have to worry about it. Okay? Another type limits on how you can approach people. If you're raising, I forget whether it's $500,000 or $1 million, so it's basically, then you can sell to whoever you want, but it has to be under, it's a small investment round. There's a variety of potential exemptions from registration.
At which point we have to worry about registering securities?
At the point where, okay, Ms. Nick Carlson, our resident U.S. accountant, who's here to answer sort of accounting questions, mentioned about an IPO, which is an initial public offering. The typical stage for companies is you have a startup, seed money, you get some angel funding, either through friends, family, whatnot. Maybe you're able to take off and develop the company, but then you get VC, venture capital, also known in the Valley as vulture capital. And you go, and then you get that, and you grow to a point where basically you're busting at the seams, and either you want additional capital that's not going to be obtained from the private market, from the private equity market, or you're looking to cash out. And normally VCs and those types of investors are looking to take the company public or have the company bought out. So that's their exit strategy. So that's when they are looking for it. So if you're looking to exit, your business plan is to build your company up so that you can take it public, cash out, and move on, then that's when you worry about it. I mean, there are some very large companies. Levi Strauss, for well over 100 years, was a privately held company. I mean, they were a huge company. They grew. They went public. Okay? And so it gets to the point where they decided to go public, and so they did an initial public offering. But there is no set time for, on your growth cycle. It depends on where you're, what you're at, and who's driving, what your business plan is. How do you want to go? I mean, it isn't necessary to go public in order to make tremendous amount of money. Levi Strauss, that company was making a humongous amount of money, but they wanted access to the public, to capital, that they weren't going to get easily without going public. So they went public to get that capital to grow even further, and they actually eventually decided to go private. Nick, didn't Levi Strauss go private?
I'm not sure.
Okay.
They might have. There are several that have gone private.
Yeah.
Doing it right now. Dell is doing
Dell,
it.
yeah. Michael
Yeah,
Dell.
well, Dell went public, and Dell's now going private, but Dell's going private through some equity funds that want to take them private. Chrysler, was publicly traded, and after bankruptcy went private. There is no sort of like, okay, you've hit these, specific points, so therefore go public or register your security. You only need to register your securities if you're looking to raise capital and you can't qualify for an exemption, or you're going, you want to go on, the public stock exchange.
I want to understand that the preferred stock financing and how it is reflected to the company books. Let's say that's the first kind of financing that one receives, 100K.
Mm-hmm.
So you get 100K of preferred stock. This goes into the capital of preferred stock. Where is the common stock coming from? Since the founders do not have any money, and how is the power divided by the common stock?
Okay. Get back to my first 5 points. It's all negotiable. Okay. It's what you negotiate. You can have in Greece, you only get in order to obtain stock, you have to put in money,
Exactly.
okay? In the United States, there is no such requirement.
But it has to be something else on the other side. What is this?
That's what you have is, if there's $100,000 in the bank account, and the preferred shareholders own 10% of the company. So what happens is you look on the outstanding stock, and you say, let's say there's 1,000 shares, total outstanding stock, 900 common to the founders, and then 100 preferred stock to the investors. So what ends up happening is you in order to have a company in the United States, you issue shares, okay? Although, let's just work with the rule for this example, that you must issue shares. So when the founders form the company, they issue shares, and they receive them. And in the United States, you don't have to contribute capital, or monetary capital, in order to receive shares. It's a concept of sweat equity, that the founders are going to, work day and night to build this company and, generate millions and millions of dollars of revenue by working really hard. So there's nothing in terms of the actual balance sheet. You have so much, you have assets of the company, and you have liabilities of the company, and you have the equity of the company. And so what's the assets less liabilities is equity of the company. And it might just be paper equity. It might just be, somebody has valued the IP at.
But in the case we discussed, you have 100K assets in your cash,
Uh-huh.
100K in your preferred stock. So
Yeah.
common stock is zero.
In terms of the value, okay, okay. Nick, what?
Sure. The common stock wouldn't be zero. It might not be much, but obviously you put something into the company. So it might be $1,000 or $10,000 as compared with the $100,000 preferred. It doesn't matter really as far as the rights and the obligations of the different shareholders. It's just a different account in the equity part of the
There has
balance
to be
sheet.
some cash.
No, it doesn't.
Well, it doesn't have to, but it normally is. You
Yeah,
could-
it normally is, but it doesn't have to be. In the United States, you do not need to contribute cash in order to have stock.
But the company has a minimum cash because they
Oh,
have to buy, one second, they have to buy a computer using some money from the company.
They have to pay legal fees.
Well, yeah, but okay,
So
but
maybe not €100, but there must
Okay.
be some tiny little cash.
no, sorry. This is a bizarre concept for Greeks. I get it. You don't have to, but you can have the company. Okay, you're talking about, so if somebody else paid for everything, the company bank account still will be zero.
Who's there, somebody else? I mean,
I have somebody that forms a company. Okay, they paid for the fees out of their pocket.
so actually
Okay.
they gave you the money.
No, okay, but you see, okay, but the difference is, when you receive you're talking about, okay, you're attributing the fact that something got spent to their capital. Okay.
To spend something on the name of the company.
Yeah,
the
that's
company
fine.
must have some initial capital, even a very small amount. We bought
Okay,
a chair.
but you're okay. Practically speaking, you are correct. But I'm trying to explain, it's not necessary. Okay? Because the other way to get the capital to form the company and pay all those legal fees is the gentleman who decides to invest $100,000. Somebody comes to me and says, hey, look, Andrew, I've got this brilliant idea. Okay? I need $100,000 to get it off the ground. Okay? I contribute the $100,000. I get the preferred stock.
Then you have other problems.
What other problems?
Tax.
What tax?
Tax. You have to pay tax.
Why?
Because actually he's paying the 100,000K.
What tax?
One second. He pays 100K.
Okay.
He gets 50%. You get
Fine.
50%.
Yes.
So actually you have 50% of the 100K for this company. So you have to pay taxes for this 50,000K.
No.
Which is increased, yes.
That's fine. We're talking about, after all, I'm explaining what is going on in the United States. This is a strange concept. I get it. I totally understand. But I can have paid zero money. The common stock can have a zero capital contribution. And realize that the capital contribution of the common stock can be zero. That's their tax basis. That has to deal with something else. Now, if we were to liquidate the company, and I were to get the $50,000, it would be, or let's say you're the one that came to me with the brilliant idea, okay? I contribute the $100,000.
I think I want to interrupt.
Yeah. And we spend $50,000 on developing whatever. And I do a poor job of negotiating, or you do a really great job of negotiating, that we liquidate the company and you get, since you own half the common stock, or you own all the common stock, which is half the company, I own all the preferred stock, which is half the company. That the agreement is that it gets split 50-50, but we now get to the liquidation preferences, and under the liquidation preferences, it's the preferred shareholders who get paid out first. Okay? So under that scenario, you don't have any, you don't get anything because we've contributed 100,000, spent 50, I'm entitled to my initial capital investment back first before you get anything. So if the company grows from 100,000 to $1 million, then I get paid out my $100,000 first, and then after that, it gets split 50-50, or however the negotiated terms are. Then yes, you pay tax when you receive the distribution of the $450,000, but that's when you pay the tax.
After the creditors have been paid?
Yes, after the creditors have been paid. We're assuming that if the company grew to $1 million, we've decided, we're done, we're going to move on. But you don't, I'll get you, but absolutely do not have to contribute any cash in order to get your shares. Yes.
When you say voting rights, what are these, what do you mean voting?
Okay.
And then the next question is, can we say for simplicity that we issue only common stocks or only preferred stocks and not to have any investors disagree with that?
If you have only preferred shares, I would say all you have are common, because if you have, there's nobody that is in front of anybody else, okay? And if the preferred shares have voting rights, what voting rights are is the ability to elect a director, okay? So, or the ability to vote on matters that impact the corporation, the company. So the voting rights, now, it's not that, again, I get back to my first 5 major points. If you have, there are ways to have preferred shareholders have voting rights, okay? So if the investor says, I want voting rights or something, Nayia mentioned briefly about a board seat. You can, somebody who has preferred shares could say, I want a member on the board. I want to be able to, appoint somebody that will sit on the board. I mean, that's negotiable. But voting rights typically are how a corporation works in the United States. Shareholders elect the board of directors. The board of directors then appoints, hire, however, the officers of the company. And the officers of the company are the ones that do the business of the company. They're the ones that go out, enter into the contracts. They're the ones that go make the decisions, and so forth. Now, this doesn't mean, you can be a shareholder, a board member, and an officer. That's fine. And in most small companies, that's exactly what happens. Most startups, the shareholder is also on the board, and the shareholder is also an officer. Now, when the investor comes in, the investor will say, "That's fine. I want a board seat because I want to have some control over who's the officer." Okay.
And somebody can have a basket of both types of shares as well, right?
Yes, absolutely. Someone can have preferred as well as common, and many preferred shares also will convert to common. And what will happen is you'll have something, because you'll want to have, voting rights, or you want to, because in many respects, while a preferred gives you some preferential treatment, if it's a growing business, the preferred stock definitely, normally will have a stated amount, dividend amount, whereas this common stock will vary depending. But that's much further down the line. And most preferred shareholders will want to convert to common before it goes public. And again, this is negotiated.
Also, the conversion rate is negotiable.
Which is
Right.
negotiated. I've seen it where, it's 2 to 1, so, one share of preferred comes into 2 of common, 5 of common, 10 of common, however they want to do it, because what happens is on that conversion, they then get a bigger chunk of the company. Okay? Yeah, why?
Regarding valuation, let's say that the company is still private. It has a few assets, let's say 100K.
Mhm.
It has a revenue of 1 million. How do you evaluate the company? Is there a standard multiplier or something? Or it's
I'm going to direct you to Nick.
No standard multiplier.
Random.
No, it's not random. It's not random. It depends on the business.
This is where you hire the accountant. No, you have to look at the potential of the company and its track record of income, if any, and come up with a way of valuing it. And quite frequently, you'll do that based on looking at other similar companies, if there are any. You look under the standard industrial classification code, and you'll see, well, what did Facebook sell for when it was still cash negative, but it had a great deal of strategic partnerships with various online advertising kinds of situations. So it's an analytical process that can be quite extensive, but it has to be done really anytime you bring in capital, or if you have stock option plans for your employees. Anytime you establish those kinds of plans, you're going to want to look at the valuation of the company. You're going to want to get a formal report from someone who's qualified to provide a number. Some of the numbers are more reliable than others, depending on how well established the company is and how clear the pattern would be.
And it in large part depends on how big the deal is. If the deal is $100,000, you're not going to go for a full formal written report. If you have a nascent company, you're not going to use that valuation for a stock option plan. But if you've got $1 million of revenue every year and you only have $500,000 of expenses, you take a look. And different industries have different multipliers. For example, restaurant industry in San Francisco right now has a 1-to-1 multiplier. So they take a look at what the revenue is and they say, okay, your revenue is $500,000, business is worth $500,000. There's some others that, and so I use restaurant only because I know none of you guys are going to be doing that, so it's a safe example, and you guys aren't going to think about that as, gee, that's how I'm going to value my company.
Well, 2 points on that. One is that even though you may not have a formal report from a third party expert, you're going to want to have your own ideas. As a founder, you're going to want to have your own idea of what's my company worth based on what I expect it to do in the next several years. And the investor is going to have a really good idea of what they think your company is worth. And they're going to have analysts that are going to do the due diligence that will say, okay, well, this company looks like it might be able to do X, Y, and Z. We may be able to make X amount of money, get our money out under the following terms. So the analysis will go on whether or not you have a third-party expert. As far as the revenue multiplier that you brought up initially and that Andrew just addressed, in business valuation jargon, that's called the rule of thumb. And the rule of thumb comes from Old England, where a husband didn't have to go to jail unless he hit the woman with a stick that was bigger than his thumb. And so it's a you stick your thumb out and you say the company is worth 2 times revenue or 1 time revenue or whatever. In real technical business valuation, there are 3 methods. There's the asset method, the income method, and the market method. And usually under business valuation practice, you have to use at least 2 methods. Very seldom will you have an asset method that will apply to a startup company, unless you have intellectual property that you can value fairly accurately, right? You can often use the income method by saying, I expect my company to make the following amount of income over the next 15 years. And you have a financial projection that shows, based on what you see as your market, your product economics, this is what's going to happen, and then you discount that back to present day dollars. And then you have the market method where you say, well, Facebook did X, and I look like Facebook, and so I'm going to use the statistics from Facebook and these other companies, and you look at their invested capital, net value of invested capital, and you look at the EBITDA, the earnings before interest, taxes, depreciation, amortization, and you do multipliers at that level. I mean, I know it's very technical, but I'm just trying to give you a flavor that, revenue, multiplier revenue is unpredictable because you can have a lot of revenue and very little income. So, I mean, income is what
So if you
controls.
get 5, 6, 10 indicators, revenue, income, assets, whatever, you compare with your peers, take your historical data and make a projection somehow.
Exactly, yeah. And, I mean, and also you should look at the market approach as well.
Yes.
Okay, I want to stay at a point of where did this common stock go? Please take it as a question, the way I understand it. I think in Greece we have the EK companies.
Yes.
I think there's allowed to put a non-monetary contribution and have shares. On the other hand, if there's only one initial investor, let's say 100K, and he only wants preferred stock, and he wants, let's say, 40%. Say there's the agreement about 40% of the company stock.
Yeah.
So the other 60% belongs, let's say, to the executives, to the founders.
Okay, so the founders, that's
yeah,
fine,
the
but
founders.
so you need to have another shareholder. You can't,
Exactly.
okay. So you can't just say, well, there's only going to be one shareholder and he's going to have preferred stock. It's,
of course.
so, okay.
And what I see, the point is that although the one has 40 preferred and the other 60 common, those 40% of preferred are still worth 100% as long as the company doesn't generate revenue or something.
No.
In case of liquidation.
Oh, in case,
all
but it's not
there.
worth. Oh, okay, okay. In that context, yes, because the preferred stock receives money first. But in terms of how much it's worth, I would say that you're taking a look at the total value of the company, taking the total number, total shares out there, and so the stock is literally worth $40,000, even though it has a right to receive the full capital contribution back before the other shareholders. There's a different, part of this is there's what you pay for your shares, which is in accounting parlance is your basis, that's your cost. And then what you sell it for is sort of the value. And so what we've been sort of bantering about with is how to come up with valuation, because you want to sell your company. Because keep this in mind, until someone pays you money for it, you can say it's worth whatever you want. There are many people that had stock before the 2009 devaluation of the stock markets that was worth a tremendous amount of money. But after the stock market went down, it wasn't worth the same. And it is only worth what someone ultimately paid. It's great to say, I have $1 million worth of Microsoft shares, but if I can't sell them for $1 million, doesn't matter.